Newmont Corporation is currently trading at $88.91, which is a solid move up, gaining $1.90 or 2.18% on the day. Now, the immediate expectation, the narrative you'll hear everywhere, is that Newmont is just doing what it always does, acting as a leveraged bet on the spot price of gold. With gold bullion pushing higher today, the assumption is that the miners, and Newmont as the king of miners, are just getting dragged along for the ride. But the reality of this specific 2.18% pop is much more nuanced and, frankly, much more important for anyone holding this stock. What the market is beginning to price in today isn't just the gold price, it's the stabilization of Newmont's extraction costs. For the last several quarters, the entire mining sector has been absolutely battered by inflationary pressures: diesel, labor, equipment, you name it. The expectation was that this pain would continue indefinitely. The reality, however, hinted at in recent operational updates, is that Newmont's massive scale, combined with the aggressive integration of the Newcrest assets, is creating a significant operational moat. This move isn't just about higher revenue from gold. It's about a fundamental expansion of profit margins, something its smaller competitors can't easily replicate. Most people who are doing some self-investing look at Newmont on their Robinhood app or through their Fidelity account and see it as a safe haven play. They buy it when macroeconomic headlines get scary, treating it almost like a high-octane bond proxy. This is a fundamental misunderstanding of the business. Treating Newmont like an ETF for gold is precisely why so many retail investors get frustrated with it. Newmont is an industrial operation. It's a logistics, heavy engineering, and geological science company that happens to sell gold at the end of its production line. The real story over the last 3 months hasn't been the day-to-day fluctuation in the COMEX price. It's been about operational execution and debt management post-acquisition. This 2.18% move today is happening on solid, above-average volume. This isn't just retail speculation, this suggests institutional buying. We're seeing the stock break cleanly through a key technical resistance level at $87.50, a level it has failed to hold twice in the last month. So why is this happening right now? It's a convergence of two major factors. First, the macro picture. We're getting persistent inflationary data, and the market expects the Federal Reserve to maintain a higher for longer stance on interest rates. On the surface, this should strengthen the dollar and be a headwind for gold. But the reality is that this higher for longer policy is starting to cause significant stress in other parts of the economy, particularly in debt-heavy sectors. This is sparking a flight to real assets, and gold is the ultimate real asset. The second factor is company-specific. The professional traders, the ones using platforms like Interactive Brokers for its deep analytics, are watching the ratio of Newmont, NEM, versus the GDX, the main gold miners ETF. In the past 10 trading sessions, NEM has begun to consistently outperform the GDX. This divergence is the market signaling that Newmont's specific fundamentals, its internal story, are now more attractive than the sector as a whole. This isn't the tide lifting all boats. This is the market recognizing that Newmont's boat is better built. When you're managing your own portfolio, perhaps through SoFi Invest or using a Schwab Intelligent Portfolio service, it's easy to just allocate 5% to a commodities bucket and buy NEM. But the active managers, the ones running Fidelity mutual funds focused on natural resources, are looking much deeper. The central story for Newmont right now is the Newcrest Mining acquisition. When that deal was announced, the expectation was that it would be a long, difficult, and expensive integration. Synergies are always promised in big M&A deals, they are rarely delivered on time. The reality that is starting to seep into the market, and what I believe is fueling today's specific buying pressure, is that Newmont is hitting its synergy targets ahead of schedule. They are rapidly divesting non-core high-cost assets, what they call Tier 2 mines, and doubling down on their Tier 1 assets, which are the large, long-life, low-cost mines like Boddington in Australia and Peñasquito in Mexico. This is not the kind of story that gets headlines like Tesla stock or Nvidia stock. This is the hard, unglamorous work of industrial optimization. It's about finding ways to use less fuel per ton of earth moved. But that efficient digging is precisely where shareholder value is created in this industry. Furthermore, the geopolitical environment is providing a solid floor under the gold price. We see persistent instability in several key regions. This drives central banks, not just individuals looking for investment help online, to aggressively purchase physical gold bullion for their reserves. When central banks are buying in size, it creates a supply-demand imbalance that directly benefits the largest, most reliable producer on the planet, Newmont. The options chain for Newmont is also reflecting this shift. We're seeing significant call buying at the $90 and $95 strike prices expiring next month. This isn't a small retail hedge. This is directional speculation, the kind of activity you'd spot on the Interactive Brokers trading platform, not just casual trades on Robinhood stock trading. These traders are placing firm bets that the reality of Newmont's margin expansion story will soon become the dominant market narrative, overwhelming the old expectation that it's just a dumb leveraged play on gold. So, for those who are perhaps newer to online investing and are looking at Newmont for the first time, what does this company actually do? Newmont Corporation is the world's leading gold company. It's also a significant producer of copper, silver, zinc, and lead, which are often found in the same deposits. Its asset portfolio is anchored in what are considered favorable mining jurisdictions: North America, South America, Australia, and parts of Africa. This is not a small speculative explorer gambling on a single discovery. This is the blue chip of the gold mining world, a core holding in many Fidelity ETFs that track the materials sector. Their business model is straightforward to describe, but incredibly complex to execute. They find massive mineral deposits, reserves, spend billions of dollars and often a decade to build a mine, operate that mine as efficiently as possible to extract the metal, and then sell that metal on the global market. Their revenue is simply their production volume multiplied by the average price of gold they receive. Their profit, however, is that revenue minus their all-in sustaining cost. The entire focus of Newmont's management is to get that AISC number as low as humanly possible. Historically, this has been a viciously cyclical stock. It performs wonderfully when gold is in a bull market and gets absolutely crushed when gold prices fall. This volatility is why many automated investing sites or robo-advisors, like those on SoFi, might tend to underweight the stock. But the expectation that this old cycle will repeat ignores the new reality of Newmont's market position. Following the Newcrest acquisition, Newmont is now responsible for a truly massive percentage of global non-state-owned gold production. It has more diversification across different jurisdictions and more ability to pivot capital to its best-performing assets than ever before. This scale gives it advantages in negotiating with suppliers and managing its cost structure that smaller miners can only dream of. When you look at your Fidelity brokerage account or manage your Fidelity IRAs, you have to decide if you believe in this new, more robust business model. This brings us to the future outlook. Where does Newmont go from this $88.91 level? The common bull case, the expectation, is simple. The Fed will eventually be forced to cut rates, the dollar will weaken, and the spot price of gold will rocket to $2,500 or $3,000. In that scenario, Newmont stock will almost certainly provide multi-bagger returns. But the real bull case, the one I'm much more interested in, is that that even if the price of gold goes nowhere, even if it just stays flat in its current range, Newmont's earnings are still poised to grow significantly. If they continue to execute on the Newcrest synergies, pay down debt, and push their AISC down towards $1,200 an ounce while gold stays above $2,300 an ounce, the free cash flow they will generate will be staggering. This is cash that will be returned to shareholders through sustainable dividend hikes and share buybacks. That is a structural driver of the share price, not a speculative one. Of course, we must be balanced. What are the risks? The surface-level expectation is that the main risk is a gold price crash. If a miraculous soft landing is achieved, inflation disappears and real rates spike, gold will get hit and Newmont will fall with it. But the reality, the one specific to Newmont, is operational and political. Mining is a dirty, dangerous, and capital-intensive business. A single catastrophic event at a major mine, like a dam failure or a pick wall collapse, or a sudden political change, like a resource nationalization where a government seizes a mine, could instantly wipe out the positive synergy story. These are the risks that investors using a sophisticated individual brokerage account must monitor, far more than the 1% moves in Apple stock.